An investor should become familiar with taxes. Indeed, the world we live in now, you can get free software and forms from the state and local governments, and it's not that daunting. There's a killer publication from the IRS, publication 17, written in 7th grade English, and it's available from the IRS at 1-800-TAX-FORM, or if you like, 1-800-TAX-1040. The world we live in is after tax, but many of the returns are quoted before tax. In more populous states, you might, say, be in a 33% bracket, and indeed a tip on the taxes. If you file a long form, you get to deduct the state taxes against the federal taxes. But let's say you get 9% fully taxable, let's say from a bond, and you would get 6% after tax. That means you get to keep 2/3 after the 1/3 tax. And you can figure that backwards. That's called the taxable equivalent, where let's say a 6% tax-free bond, well, you now divide by 1 minus the tax rate, and that would be equivalent to a 9% before tax return. Notice that if you're in a lower tax bracket, say for retirees, those tax-exempt bonds are not very attractive and are only at best suitable in cash accounts. Well, what are some of the other accounts? There's your pension account and your individual retirement account, those IRAs. And the traditional and pension accounts are tax deferred, and if you pay a tax, say 20 years later, it's equivalent to cutting it roughly in half in terms of present value. The Roth IRA, you get no deduction and there is no tax on it. That means it's tax-free, but you get no tax deduction going in. This is suitable, say, for bonds. Capital gains and qualified dividends are currently and may not continue at a lower 15% rate, and I note that therefore you would not be appropriate to put these into a tax-deductible account such as a traditional IRA. More than one market guru has suggested taking your age as a percent and making that the fraction that you put into bonds. You could make it higher if you want to sleep well, or lower if you want to eat well. You take the rest and put them equally, as I suggest, in index, no-load mutual funds, global and growth funds, and once a year while doing your taxes, you might rebalance them, meaning move them back to an even number of fractions between them. And notice what it does. It has you take the ones that have increased, selling high, and buy more of those that have decreased, which means you've bought them at a lower price. You've sold high and bought low. That's pretty good, huh? While at the same time pursuing the ideas of diversification. Let's look at information. There's too much of it if you think about it, and the price of a security is a function of the information at a current time period, whether it's right or wrong, and that's likewise true for tomorrow. And tomorrow's price change comes from tomorrow's news, which is generally unknown, and we expect on average to be roughly zero with a slight gain. Now, information can be broken down into various subsets. There's the historic information consisting, let's say, of charts, and that's the weak form of the efficient market hypothesis, and that's a subset of public information called the semi-strong version of the EMH, and here we add on news, now being current, and those are subsets of all information, which is then the addition of private information. And the idea of the efficient market hypothesis is that you either can or cannot get an excess return using those various forms of information. Here are some weak form tests of historic prices. Here's a version of moving averages, and they sure do seem to give you signals on when to buy low and to sell high as they cross over. And I should note these were created by random numbers that I wrote. Another test was the trendline charting, which I examined. No excess return, and my own studies have found there is no correlation going 6 days back or forward between a previous price and a future price. The semi-strong version looks at news announcements. An example is stock splits, And sure enough, stock splits are associated with rising prices, but after the price rise, there is no excess return after the announcement of the stock split, with a slight difference of whether or not the company has announced a dividend rise or not, as would be expected. But when we look at the strong form test, trading on inside information, here's a question for you. Why do we make trading on inside information a crime? Well, in any case, it comes as no surprise that you can get an excess return. And the EMH, the null hypothesis, is that you cannot get an excess return from the appropriate benchmark. And the alternative is that, well, yes, you can. And thus, the excess return is not achievable with past information, nor current news, and vice versa. And so thus the weak form and the semi-strong tests are supported, and the strong form test is not. Why do we make insider trading illegal? Well, it's not to be fair, but instead it's to recognize that if I were to participate in a market where others had privy to information and could act on it without sharing it, that I would demand a higher return. And if I, like everyone else, demanded a higher return, we'd have lower values, less employment, and so on. It would be an undesirable world for all. Let's talk about mutual funds. And they're available for any category of security. There are index funds. They're passive. They usually don't charge a load charge, and they just mimic the market. Then there's actively managed funds, often have a load charge, often sold by institutions that have a vested interest. And typically one version is called A-type funds, and they have a fee up front. And then there's B-type funds, which have a rear-end charge, often decrementing maybe 1% for each year you stay with them. So if you go in for 5 years at 5%, hold them 5 years, then you can get your money out without any charges. Well, profits, of course, are revenues minus cost. And the EMH has taught us that you cannot get higher revenues no matter how good or active you are in terms of research. But that research costs money, so therefore it's no surprise that index funds, regularly 9 out of 10, beat actively managed funds. Well, regardless of the fund type, there are some details you might want to give further examination. There are various fees that are broken down. One of them is the 12B1 fee. That's for promotion, the number coming from a 1940s section in the code for the SEC, and it's for advertising and promotion, and allows many a brokerage firm to give you their mutual funds of another company for free, those fees absorbing that commission. So it's no cost to you, as well as advertising. And there's expense ratios. These can be high and low. I'd look for 1/2 or lower for the 12B1 fees and maybe 1% for the expense ratios. Also look for turnover ratios. The more frequent they trade, the more frequent those capital gains are reported to you, which become taxable. Also look out for end of the year tax distributions. Now, some funds specialize in minimizing the tax bite to you. They're called tax efficient funds, but most studies show that they don't do a very good job in terms of getting a good return, so I wouldn't make that the idea of the tail wagging the dog. I'd much prefer to pay a lot of taxes on a lot of profits than any other combination. This is Dr. C Invests.